G'day folks, welcome back to another update for the commodities. We're looking at high-grade copper, iron ore, gold, US crude, silver and platinum. Before you go any further, make sure you hit that like and subscribe button to help support the channel. In terms of the outlook, as of today, July 2nd, high-grade copper prices are projected to average $98.90 per tonne in the second half of 2025, peaking at $10.050 in August, driven by energy transition demand and limited new mine supply. For iron ore, UBS forecasts an average price of $100 a tonne in 2025, with potential declines due to trade tensions, resource nationalism and environmental regulations. For gold, after peaking at $3,500 an ounce in April, prices have dipped about 5%. Analysts anticipate a pullback amid easing geopolitical tensions and delayed Fed rate cuts, though central bank purchases continue to provide support. For silver, June saw a 10% gain, with July poised for continued growth due to seasonal trends and industrial demand from solar and semiconductor sectors. Platinum forecasts suggest a rise to $16.27 an ounce by year end, supported by industrial demand and a market deficit though prices remain range bound. For US crude, prices have climbed about $68 a barrel amid Middle East tensions, but S&P analysts predict a potential drop in the upper $40 later in 2025 due to projected supply surplus and weak demand growth. So looking at high-grade copper first, we always look at the long-term trends. So on the monthly, the first thing we look at is the trends above the moving averages. So the price and the CCI are both above the moving averages, giving us a bullish momentum, and it's approaching this resistance up there at 53.953. Now you'll notice we had here a bearish divergence, lower highs on the CCI versus high highs on the price. Now that actually pulled back and hit our target range initially, so it may actually have completed the divergence. You'll notice the CCI slowly rising, but the price is still below that previous high. So we're going to keep that divergence in play. All I'll do, I'll just move that trend line to that point there. So long as that's still bearish and the price remains below that resistance area, I'm going to consider that a bearish divergence, which means we may see further declines. But again, that could be a long-term play. On the weekly, likewise, the price is above the moving averages, and so is the CCI, bullish momentum. It's broken through this previous resistance at 59.12. There's no divergence there. You can see the CCI is moving in line with the price, so there's no divergence there. One thing to mention as well is we've got these, if I zoom in a bit, we've got these blue and red areas which are fair value gaps, and what that means is when I'll choose that candle there for example, let me just zoom in for a moment, demonstrate on that candle there. Once these three candles, to measure the fair value gap of that candle, we wait to see the candle after it complete. So what we do then is we measure from the high of that candle to the low of that candle, and that's that area there. That's called a fair value gap. This one came and penetrated about 25% of that area, then it bounced, but ultimately it broke down and covered the full range with those two candles there. So in other words, these fair value gaps can be, breached months or even even years later, depending on what time frame you're looking at. You can see this one back here was breached about 50% based on that little wick, but then finally broke through the whole 100% of it through with the wick of that candle. Another fair value gap there, 75% there, another one there, but ultimately all those were breached to the full 100% range. So always be aware of those fair value gaps. That's the weekly. So the weekly is bullish as well, above the moving average, as I said, and it's covered those fair value gaps. There's no fair value gaps yet uncovered, yet to be breached on the monthly, so that's okay there. On the daily, however, if I zoom into this one, you'll see there I've marked this fair value gap up there. So we may see that wick there on that candle has probably just touched that fair value gap. So we might see the price move higher to fill that fair value gap in the coming days possibly. Although I notice the CCI is pulling back, so it could always retrace. This is we primarily look at the trend above the moving averages, and then we look at the trend of the CCI if it's coming back and looks like it's weakening. The price has been flat since our last video. So we might see a bit of a retrace and then possibly a bounce further to the upside to fill that fair value gap. And again, there's those fair value gaps previously covered in those past weeks or months. So if we go to the intraday charts, we've got the daily here as a reference. We predominantly take long trades during that period. So here on the hourly, first off, before our last video, we drew this bearish divergence, lower highs on the CCI versus higher highs on the price. Now that divergence was invalidated, because as you can see there, that high there move it there. That high there is now higher than that one, which means it's no longer a bearish divergence. So what we do is we just ignore it, and we're going to delete that projection of a bearish divergence. So then the CCI started moving in line with the price. You've got new highs on the CCI and new highs on the price at that point. Then we start seeing a CCI drop, and so did the price has actually dropped slightly. But is there a divergence? And I can't see a divergence currently, although you might argue that's a bearish divergence there versus that point. So lower highs, higher highs there, lower highs on the CCI. And what will you do? And you can just see it with eyeballing it there. If we drew a Fibonacci from that point to that, it's already broken through that 23-38% range. But even if we took it back to that low there, it's also broken through. If we take it right back to that major low, it's also broken between the 23 and the 38%. And that's our minimum target range. So that has played out already. Now you'll notice here as well on the hourly, we've got a fair value gap there, which I'll mark. So we might see a price rise in the near term. You can see there the CCI has broken into that. So predominantly, as I said, predominantly long trades based on the daily. If you're trading on the hourly, that bearish divergence seems to have played out. So if you're going long during that period and you saw that, you probably should have closed out your positions once that CCI dropped into that moving average range. So you would have closed it out on that bearish candle there. Now, since then, as soon as that breaks higher than that moving average on the CCI, that's where you would enter another long trade, and that'll most likely fill this fair value gap as well. Now, also, while we're here, we look at the back test, and we'd be going long. So what I've done here on the back test, I've got the stop loss approach and the average down approach, and they both yielded the same result, by the way. And that started back here when the CCI broke and the price broke above the moving averages on the daily, and that was from the 23rd of June, roughly, from these points. And you would have gone long during that period when both the CCI and the price broke above the moving averages. And you can see there during that period, you would be making about $1,400 on both those strategies. And you'd be closing it out as soon as you see that CCI break into that moving average band. Now, you could actually close it out on the hourly as well at each of these points once it breaks into that, but it's a bit volatile. You can see there it's making a few false breaks. But at the moment, I'm letting it run until the daily breaks into that moving average band there. Next, we look at iron ore. Now, on the monthly, there's no CCI for it, so we can't tell if there's any divergence, but you can see there the price is below the moving averages, giving us a bearish momentum, and it's currently stuck in this support resistance range. Now, we did have a few fair value gaps there, and they've all been covered. This one back here has been covered about 50%, so that's a bit of a caution, so we might see further rises, but at the moment, predominantly we're seeing a downtrend on the monthly. On the weekly as well, both price and CCI below the moving averages. That's giving us a bearish momentum, and those fair value gaps have all been covered as well. If I zoom out, you can see there they've all been covered on the weekly. On the daily, however, we do, and there's no divergence on the weekly. On the daily, we did have this bullish divergence on the CCI, higher lows versus almost a triple bottom on the price. Now, since then, it's actually bounced. And if we go to so at the moment, it's bullish on the daily. So if you're trading on the hourly, you should be taking long trades because that's broken higher. It's already broken into that fair value gap, covering that fair value gap. So we may see further upside, but just be cautious. So let's look at the hourly now. So if you look at the intraday, the hourly, you can see there we had a bullish divergence on the daily, but also a bullish divergence on the hourly as well. Now on this one, I drew a target area here on our last video, and that was drawn from that low to that high. That's at 23-38% range. So it looks like it's either the divergence has failed, or we didn't draw the Fibonacci accurately enough. That was a bit of a stretch, but I still like to take it back to significant highs. We could have taken it back to any one of these previous highs, and you can see there each of those areas would have been breached in that 23-38% range. So again, depends where you draw the Fibonacci's. I like to take it back to the significant high where there was some sort of resistance in this case. No matter, we don't trade that anyway. The way we use that divergence, if you're going short, and I'll show you the back test in a moment, if you're going short during this period and you notice these divergence, at that point there was no divergence. That high is still higher than that high. But at that point, you would have noticed a higher low on the CCI versus a double bottom at that point. That was your first indication of a bullish divergence. So if you're going short during that period, you probably should have taken heed, noticing that there was a bullish potential, and you should have closed out your position somewhere around there. So what that means is, let's go to the back test. So what I've done here is I've started the back test from when the price broke below the moving average at that point, and so did the CCI, and that was in this position here on the chart, on the 1 hour chart. Both the stop loss and the average down approach yielded the same result, about 17 points. There was no average down happening, and that broke down and bounced off that support level a couple of times, as I said. So again, if you're following that, you notice that first indication at that point, you probably should have taken your profits off at that point there, which was slightly higher to where it is now. So again, don't let it run through. If you follow the hourly as well to watch for any divergence. So you would have probably taken your money off the table at that point there, after that higher low there versus that equal low there. So you would have got out there with approximately 25 points instead of 17. So that's why you always pay attention to these divergence. So here we have gold. On the monthly, there's no CCI for it, so we can't tell if there's a divergence, but on the price chart, it's very strongly bullish. Now we've also highlighted these two fair value gaps down here. So we might see a price, even one down here on this support level. So we might see a very strong pullback at some time, and this could take years to play out. So I don't go placing short orders on those. Again, just an indication where the price may retrace back to. They say the monthly is bullish at the moment, with still moving higher. On the weekly, we still have a somewhat neutral positioning, where the CCI is showing a bearish move with a bearish divergence here versus high highs on the price, and the price has actually stagnated somewhat in the last few weeks. And again, there's those fair value gaps on the weekly as well. So again, just be cautious about going all your money on gold. We might see a bit of a weakening sometimes in the not too distant future. So bearish momentum on the, or bullish momentum on the weekly, but bearish divergence showing, which means we may see a pullback. And if we see the price pull back through those moving averages, then we might start taking, if you're trading on the daily, start taking short trades on the daily. But at the moment, avoid going short on the daily. On the daily, that's what we look at if we want to go trading on the hourly. Again, it's having trouble breaking through that resistance up there at 3,500. We've seen the CCI dropping off, and that was a result of this, if I zoom out, result of this bearish divergence, almost a double top on the CCI versus high highs in the price, and that broke down into our 23-38% Fibonacci range, highlighted by that blue rectangle. Again, shorter term, notice these bearish, or on the bearish side, these fair value gaps, so we might see the price break to the downside sometime soon. And you'll notice here very quickly, we've got this fair value gap up here, so again, we might see a bit of a retrace to the upside. Alternatively, if the price continues to the downside, it will cover this fair value gap, which is currently, looks like it's going to be hit soon. So again, I don't trade those. I'm just using it as an indication of where the price may head in the near term. So on the daily, bearish momentum, both the CCI and the price are below the moving averages, or the CCI is broken into the moving average, but could go either way. But if you're trading on the hourly, I'd be holding off until the price and the CCI confirmed one way or the other. So if we look at the daily, look at the hourly, I should say, before we go to the back test, let's look at the 1 hour chart without all the back test results. So you can see here, predominantly would have taken short trades beginning from around about the 23rd of June, going short, and you would have closed it out at the very latest when that CCI hits that moving average range. So what we're seeing here at the moment, though, on the hourly, if you're going short during this period, you tell me when should you have taken your profits. Before our last video, you'll notice here the price was making a bit of an upswing, and so was the CCI. So the CCI was moving in line with the price. But since our last video, the price kept dropping. The CCI dropped as well, but notice what we've got here is a bullish divergence. So to that point, draw a trend line, higher lows on the CCI to the same period. We'll take it to that point, lower lows on the price. So what it did then is it bounced, and that's why I'm saying we look at a Fibonacci retrace to that high, and it broke quite easily, very easily through that 23-38% Fibonacci range. That's our minimum target range of a retrace, and this one went as high as a 50% level, and it's currently leveling off. So that's how you should have closed out your positions if you're trading short positions here on the hourly based on the daily trend. Remember, always trade in the direction of the higher time frame. If you're trading on the daily, as we said, if we go back to the monthly, weekly, daily charts for a moment, if you're trading on the daily, I'd be avoiding going. I'd probably take my profits at the moment until we started seeing the CCI break higher as well. But if you haven't entered the trade yet on the daily, I would avoid going long or short until we see both the CCI and the price moving in the same direction. So don't go based on the daily alone, or on the price alone. Now, if we go back to the intraday and the back test, so as I said, we would have taken short positions when the price broke below the moving average, and so did the CCI, and that was indicated by this period back here around about the 23rd of June. You would have taken short positions, and both, if you left it run through the whole period, both would have yielded about 167 points or dollars. Again, taking note of this bullish divergence, you should have got out the very latest somewhere around this period, especially when it broke into that moving average range on the price. But notice the bullish divergence, and you would have got out somewhere near the peak there. So instead of 167, you would have got out with about 663 on both those strategies. So silver's got a similar pattern to gold in terms of bullishness. We've got the CCI for it as well, showing a nice trajectory above the moving averages. So bullish momentum on the monthly. Again, there's that fair value gap down there for silver, which coincides with these moving averages. So we might see a pullback similar to gold in the near term, or when I say near term, could be years before that happens. So don't go placing short orders. And so again, bullish momentum on the monthly. On the weekly, likewise bullish. But notice we had this bearish divergence. The price kept rising, but the CCI kept falling, and it actually fell into our 23-38% range, sort of hovered around there for a while, broke out of it, and continued an upward trajectory, broke through that previous resistance at 34.87. But it's currently still bullish on the weekly. And again, there's that fair value gap. So we might see in the short term, next few weeks or even a couple of months, we might see a pullback in that area, coming towards that moving average. The CCI is already pulling back, but again, don't go placing short orders. We take trades based on the trajectory of the moving averages and the price and the CCI. On the daily, we've got another bearish divergence. It hit this resistance up here at 37.25, and it broke down. And that would, if we drew a target range, let me just zoom in on that for a moment. So if we drew a target range on that, you would have taken it back to that level. And you can see there the target range for that one, estimated about a 23-38% range, Fibonacci range. It hasn't quite hit it yet, and that corresponds with these previous resistance we had, and now their support at 34.87. So it looks like it may come back down into that area, but also know it corresponds with this fair value gap we've got highlighted here between those candles there and those candles there. So it looks like the price may pull back further into that fair value gap on the daily. Now, if we go to the 1 hour chart, so currently taking predominantly short trades from around about the 29th of June. So just starting to trade there. But again, notice, and I'll demonstrate the back test going along and how you would have got out of it. But again, notice the two bearish divergence we had here, and I've drawn target ranges for them. That one was hit with that wick of that candle there on the first one. The price kept rising, the CCI peaks kept dropping, and then the second 23-38% range was hit at that point. And it's been fluctuating in that range now, as I said, with the CCI also pretty much bouncing in that range. So going to the back test, and again, I've started the back test here from about the 2nd of June, and both the stop loss approach and the average down generated about 14,160 points or dollars, depending on what you were trading. And again, you would have got out of it. The first point there would have been that peak, one of those peaks there. You should have got out at that point. And since then, the profitability has been pretty flat. The price dropped off a bit. But if you're still in a trade at the very latest, you should have got out at that one. So instead of 14,160, you would have gained, if you got out at the peak after the peak there and the bearish divergence, you would have got out with 17,540 approximately. Once you started seeing the price break through that moving average range after that second bearish divergence started playing out. So US crude on the monthly, it's below the moving averages on the price and below the moving average of the CCI, giving us a bearish momentum. I've highlighted there these two fair value gaps, one's above and one's below, and it looks like it's approaching this bottom one first. In fact, that fair value gap in there was penetrated by these 2 wicks of those candles, so that's already been accomplished, but we've got these ones yet to be filled. So we might see a bit of a dip initially before further upside. And again, this could take years to play out. So again, don't go placing orders based on those. It's just an indication of where the price may go in the near term. There are ways of trading the fair value gap, but I'm not going to cover that. I'm just going to keep the trading strategy simple for the sake of these videos. I might cover it in a future event though. Now on the weekly, we had this, you can see there the fair value gap was penetrated with these wicks initially, then through that candle there on the weekly. But at the moment, the weekly direction is bearish on the price and entered neutral to bearish momentum on the CCI. So it looks like we have possibly further downside in the near term. And again, notice there we had this fair value gap which was penetrated by that period there, but we've got another little one there, it hasn't been touched yet. So just be aware of that. We might see further downside here. On the daily, bearish on the price and somewhat bearish to neutral on the CCI. And notice here we had a bullish divergence. So again, it's bounced off a double bottom there, higher lows there, and it bounced quite strongly. This one went almost 100 to 100% retrace level if you draw a Fibonacci level to that point there. So at the moment, bearish to neutral on the daily. Going to the intraday chart, currently you'd be taking short trades. As soon as that breaks below on the daily, you'd start taking further short trades. You can see there on the 1 hour price chart, it's currently bouncing off this support at 63.83. That's also as a result of this very small range bullish divergence. Sometimes these smaller ranges ones are a lot more volatile, so we possibly might see a break higher in the near term. And I've drawn this 23.38% Fibonacci retrace, so it hasn't hit that range yet, so we might see the price bounce into that range in the near term on the hourly. I've also highlighted this fair value gap as well, which hasn't been breached, and that could be in support of this bullish divergence target. So again, and I'll demonstrate the back test on using the long positioning. And I've taken the long positions back to about the 25th or 26th of May at that point there on the daily, showing it where it broke above. And you would have taken long trades during that whole period. Now again, we had a few little bearish divergence played out during that period. The first one is this little area here. You would have got out there somewhere in that range there, generating about 450 odd points. The price kept rising. The CCI followed suit in the same trajectory as the price, new highs, new lows, until it started getting the bearish divergence. And the first sign of a bearish divergence was at that point there. You can see there those highs were lower, and so were those highs, so there's no divergence there until that point there. That high ended up being higher than that point versus the CCI points. So that would have been your first clue to get out of the long positions if you're going long, and at that point you would have generated about 10,880 points versus had you stayed in the whole position, you would be down to about 6,600 points at the moment on the stop loss and about 2,200 on the average down. It's averaged down here a couple of times, and at the moment you're in a bit of a drawdown there. So that's if you're ignoring these bearish divergence, and that's how I trade the divergence. I don't trade them in isolation. I trade them in direction. If I was going long during this period and I see a bearish, I get out of the trade as soon as I see a bearish divergence. That also gives you an early exit as opposed to waiting for the daily to break into that moving average range, which is what you normally do. You normally wait for that period. If the CCI is moving in tangent with the price, then you can usually wait for that CCI on a daily to break into that moving average range. Otherwise, get out of the trade if you see a bearish divergence like it did here. And lastly, platinum on the monthly has had a huge spike last month, and this month so far it's a couple of days. It's just currently sitting there, just consolidating. There's no CCI for it, so I can't really tell if there's a divergence. But bullish at the moment on the monthly. However, notice we've got this fair value gap down there, which hasn't been touched yet. So we might see a pullback very strongly in the coming months, possibly. And that, again, this could take years, but we don't know. On the weekly, bullish momentum on the CCI as well as the price. So that's the first thing we look at. Next, we look at any divergence, and there's no divergence that I can see. And thirdly, we look at any fair value gaps. And you can see there's a few fair value gaps which haven't been touched yet. And again, that sort of correlates with the monthly, which means we may see a pullback towards these moving averages. On the daily, zoom in on this one. On our last video, we drew this bearish divergence to that point. Now, since then, the price on the daily rose slightly, but the CCI didn't really change much. So that was still a bearish divergence, and the price has pulled back. Now, before we go to the fair value gap, at the moment, the price is bullish, but the CCI is bearish, which means we may see a pullback. It's currently having trouble breaking through those previous highs. And if we do to draw a target range of our 23-38% Fibonacci range, then I'd put a little rectangle there to highlight the target range, and that's our 23-38% Fibonacci. So you may see that the very minimum, that's a minimum by the way, to break into that. Sometimes it could just kiss it and then bounce. Other times it could break a lot stronger through it. And this fair value gap is an indication we might see further downside in the near term. The CCI doesn't look like any time soon it's bouncing. And again, this fair value gap is identified by these ones here, right down to that one there, which haven't been penetrated yet. So just be aware of those. And if we go to the 1 hour chart, you would have been going long during that period. And again, you would have been taking note of this, on the daily at least, taking note of that bearish divergence, and trading on the hourly based on direction of the daily. You were taking long position during that period and stop taking long positions after that point there. So on the hourly here, that's what first thing we look at is any divergence. Well, first of all, you can see that it's consolidating in that range above and below those moving averages, and so is the CCI. So it's really undecided yet. But in terms of divergence, there's no divergence to that point. That CCI is moving in line with the price. Those highs are higher, and so are the price height peaks, until we get to this point here where we see a bearish divergence. That's a very narrow range of movement. And as I said, these narrow ranges are usually more volatile. So if we take a Fibonacci retrace down to that low there, you can see there it broke very quickly through that 23-38%, almost to the 61%, and it's been consolidating in that range since. So I'll just mark that as a target hit for reference. Mark it there. So that's already hit and broken through that range. So what it means is if you're trading on the long positions, again, you should be taking short positions. If you see that price break below the moving averages, start taking short positions. Otherwise, stand clear until we see the price and the CCI moving averages going in the same direction. But if you're going long, and I've started the back test here from around about the 5th of June, when the price is above the moving average, and so is the CCI. You can see here on the stop loss approach, had you let it run through the whole period, it would have generated about 10,000 points versus the average down generated about 15,600, and it's averaged down once in that period there. But again, based on the hourly, you would have taken note of any bearish divergence. There was a couple there, and the first one you should have closed out your position at that point there once the price broke below the moving average. Now the stop loss approach coincidentally happened to close out as well. So had you closed out your positions there, the stop loss approach generated about 5,100 versus the average down, had you let it run or closed it out, it generated about 3,400. Now after that, the CCI and the price moved in tangent, and again there was no divergence that I saw there until that point there. I've already identified there's a bearish divergence there, and you should have got out at that point when it hit the moving average, or when it hit the divergence target. So at that point you should have got out of the trade. The stop loss approach generated 12,700, and the average down generated 17,500 because you multiplied your positions there. That's why it generated more income. So again, that's the benefit of the average down, but again, you've got to be very careful of drawdown on using the average down. So at the moment, you'd be standing clear and waiting for the price to break below the moving averages, or alternatively wait for the CCI to break higher through those moving averages to give you a bullish momentum. If you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. And if you enjoy the content, subscribe at least on the free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.